On Friday, Iran declared the Strait of Hormuz completely open for the first time since February. Oil prices fell more than 11% in a single session, and the S&P 500 pushed past 7,000 to a fresh record high. But buried inside Tehran's own announcement is a detail that virtually no equity desk seems to be pricing in. Iran's foreign ministry has explicitly tied the reopening of the strait to the duration of the 10-day Israel-Lebanon ceasefire, while the separate U.S.-Iran truce, brokered by Pakistan, is set to expire on April 22nd. That gives the global energy system roughly 9 days before the legal scaffolding holding it up dissolves. Polymarket currently gives a permanent U.S.-Iran peace deal by April 22nd only around a 43.5% probability, and high-level talks in Islamabad on April 11th and 12th collapsed without an agreement. So in this video, we'll explain why this 9-day window matters far beyond the oil price, how it connects to a quietly unraveling corner of the U.S. debt market, and why the Federal Reserve may be more trapped than at any point in the post-pandemic cycle. Now, let's start with the geopolitics, because the framing in mainstream coverage is, in our view, badly misleading. The current calm is not a peace deal. It is a temporary memorandum brokered by Pakistan's Field Marshal Asim Munir, who is reportedly pushing for a 45-day extension simply to keep the parties from returning to open conflict. Gulf and European officials, speaking to the Financial Times, privately estimate that a durable settlement will take roughly 6 months. It's worth noting that even the physical reopening of the strait is conditional. Vessels must follow a coordinated route hugging the Iranian coast. The U.S. naval blockade of Iranian ports remains in full force with around 10,000 troops and 13 vessels turned away since April 13th, and the IMO and Maersk are still demanding safety guarantees, particularly because Iran may not have the capability to clear all the mines it has laid. This is not a normal reopening, and the market is treating it as one. For context, Brent peaked between $115 and $118 a barrel during the March blockade, what the IEA has described as the largest oil supply shock in history. That shock fed straight through to inflation. March CPI came in at 3.3%. Gasoline prices surged 21.2% on the month and accounted for roughly 3/4 of the headline increase, and PPI hit a 3-year high of 4.0%. This brings us to the part of the story the equity rally is ignoring entirely. Over the past few years, U.S. banks have extended approximately $300 billion in credit lines to private credit funds, according to Moody's, with J.P. Morgan alone disclosing around $50 billion of direct exposure. The asset class itself is now worth roughly $1.7 trillion in the U.S. Fitch reports that the trailing 12-month default rate in private credit hit 5.8% through January, the highest level since the metric's inception, while the full-year 2025 figure was a record 9.2%. Approximately 40% of private credit borrowers now have negative free cash flow. And there is a $162 billion middle market refinancing wall stacked into 2026, sitting inside a much larger $1.65 trillion total maturity wall across leveraged credit. In Q1 alone, redemption requests across non-traded private credit funds hit $20.8 billion, forcing BlackRock, Carlyle, Blackstone, and Blue Owl to gate, restrict, or permanently halt withdrawals. So why does a 9-day geopolitical window matter for any of this? Well, the way we see it, the transmission mechanism is uncomfortably direct. If the strait closes again on April 22nd, oil plausibly returns toward the $115 range we saw in March, energy-driven inflation re-accelerates into already sticky core prints, and the Federal Reserve loses what little flexibility it has left. CME FedWatch is currently pricing a 99% probability of no cut at the April 28-29th meeting, and Fed funds futures now imply less than 125 basis point cut for the entirety of 2026, a dramatic collapse from the 3 to 4 cuts priced at the start of the year. Chicago Fed President Austin Goolsbee has explicitly warned that persistent oil pressure could push cuts into 2027. As such, the private credit ecosystem is being asked to refinance a record maturity wall with a record default rate into a higher for longer rate regime that the Fed cannot escape, all while Powell's term ends on May 15th and his successor Kevin Warsh faces his Senate hearing on April 21st, one day before the ceasefire expires. It is perhaps not a coincidence that on April 13th, S&P launched the FINDX index, the first standardized CDS benchmark including direct exposure to Apollo, Ares, and Blackstone. Analysts are openly drawing the parallel to the 2006 ABX subprime index, though we should stress that today's leverage and capital ratios mean this rhymes with 2007 rather than repeats it. Broadly speaking, then, the question is not whether the ceasefires extend, Polymarket gives that around an 80% probability, but whether an extension is enough. Because even Scott Lang at the University at Buffalo notes that, with tankers needing 5 weeks to reach U.S. shores, gasoline pump prices may take a full year to normalize. The inflationary damage may already be locked in. The rate cuts the credit market is desperate for may already be off the table, and the 9-day countdown is simply when the equity market is forced to notice.